Investing is a powerful way to grow your money, and the earlier you start, the better your financial future can look. As a teenager, you might be wondering where to begin. Whether you're saving for college, a car, or just building wealth, this guide will walk you through everything you need to know about investing as a teenager. Chapter 2. Understanding the basics. Before diving into investments, let's understand the basics. Here are some key terms you need to know. 1. Stocks. When you buy a stock, you're purchasing a small piece of a company. If the company does well, the value of your stock can go up. 2. Bonds. A bond is like a loan you give to a company or government. In return, they pay you interest. 3. Index funds. An index fund is a collection of stocks or bonds that mirrors the performance of a specific market, like the S&P 500. 4. ETFs. Similar to index funds, but they trade like individual stocks on the stock market. 5. Compound interest. This is the interest you earn on both your original money and the interest that money has already earned. Chapter 3. Getting started. Now that you know the basics, let's talk about how to get started. Step 1. Set a goal. Why are you investing? Is it to save for college, buy a car, or start a business? Having a clear goal will help you stay focused. Step 2. Open an investment account. If you're under 18, you'll need help from a parent or guardian to open a custodial account. Popular platforms like Fidelity, Vanguard, or Robinhood offer these accounts. Step 3. Start small. You don't need thousands of dollars to start investing. Apps like Acorns or Stash let you invest with just $5. Step 4. Diversify your investments. Don't put all your money into one stock. Spread it across different investments to reduce risk. Chapter 4. Investment options for teenagers. Here are some investment options that are great for teenagers. 1. Individual stocks. Start with companies you know, brands you use every day like Apple or Nike. However, remember to research before investing. 2. Index funds and ETFs. These are beginner-friendly options because they reduce risk by spreading your money across multiple stocks or bonds. 3. Roth IRA. If you have a part-time job, you can open a Roth IRA. Contributions are made with after-tax dollars, but the money grows tax-free. 4. Mutual funds. These are managed by professionals, which makes them a good option if you're unsure where to start. 5. Cryptocurrencies. These are volatile and risky. Only invest a small amount if you're interested, and be prepared for ups and downs. Chapter 5. Essential tips for teenage investors. Here are some essential tips to help you succeed as a teenage investor. 1. Educate yourself. Read books, watch videos, and follow reputable financial blogs to learn more about investing. 2. Invest regularly. Invest regularly, even if it's a small amount. This builds discipline and takes advantage of dollar-cost averaging. 3. Stay focused. Don't panic if the market drops. Stay focused on your long-term goals. 4. Monitor your portfolio. Use apps or spreadsheets to monitor your portfolio's performance. 5. Avoid debt. Avoid using credit cards or borrowing money to invest. Only invest money you don't need in the short term. Chapter 6. Common mistakes to avoid. Here are some common mistakes that new investors make, and how to avoid them. 1. Understand what you're investing. And always research before investing. 2. Investing is a marathon. Avoid schemes that promise quick returns. 3. Diversify your investments. Don't put all your money into one stock or sector. 4. Watch out for hidden fees. Hidden fees on investment platforms can eat into your returns. 5. Be patient. The market has ups and downs. Patience is key. Chapter 7. Advanced investing strategies. Here are some advanced investing strategies to consider. $1 cost averaging. Invest a fixed amount of money at regular intervals, regardless of the market's performance. 2. Value investing. Look for undervalued stocks with strong fundamentals. 3. Growth investing. Invest in companies with high growth potential. 4th. Dividend investing. Invest in companies that pay consistent dividends. 5th. Tax loss. Harvesting. Chapter 8. Investing in real estate. Investing in real estate can be a great way to diversify your portfolio and earn passive income. Here are some ways to invest in real estate. 1. Direct property investment. Buy a rental property and earn income through rent. 2. Real estate investment trusts, REITs. Invest in a company that owns or finances real estate properties. 3. Real estate crowdfunding. Invest in real estate development projects or existing properties through crowdfunding platforms. 4. Real estate mutual funds. Invest in a mutual fund that focuses on real estate investments. Chapter 9. Investing in cryptocurrencies. Cryptocurrencies like Bitcoin and Ethereum have gained popularity in recent years. Here are some things to consider when investing in cryptocurrencies. 1. Understand the technology. Learn about blockchain technology and how cryptocurrencies work. 2. Volatility. Cryptocurrencies are highly volatile, so be prepared for price fluctuations. 3. Security. Make sure to use a secure wallet and exchange to store and trade your cryptocurrencies. 4th. Regulation. Keep an eye on government regulations and how they may impact the cryptocurrency market. Chapter 10. Investing in gold and other precious metals. Gold and other precious metals can be a great way to diversify your portfolio and hedge against inflation. Here are some ways to invest in gold and other precious metals. 1. Physical gold. Buy physical gold coins or bars and store them in a safe place. 2. Gold ETFs. Invest in an exchange-traded fund, ETF, that tracks the price of gold. 3. Gold mining stocks. Invest in companies that mine gold and other precious metals. 4. Gold mutual funds. Invest in a mutual fund that focuses on gold and other precious metals. Chapter 11. Investing in international markets. Investing in international markets can be a great way to diversify your portfolio and earn higher returns. Here are some things to consider when investing in international markets. 1. Country risk. Understand the risks associated with investing in a particular country. 2. Currency risk. Understand the risks associated with currency fluctuations. 3. Regulatory risk. Understand the regulatory environment in the country you're investing in. 4. Cultural risk. Understand the cultural differences and how they may impact your investment. Chapter 12. Investing in sustainable and responsible investments. Sustainable and responsible investments, SRI, are investments that align with your values and promote environmental sustainability, social justice, and good governance. Here are some things to consider when investing in SRI. 1. Environmental sustainability. Invest in companies that promote environmental sustainability. 2. Social justice. Invest in companies that promote social justice and human rights. 3. Good governance. Invest in companies that have good governance practices. 4. Impact investing. Invest in companies that have a positive impact on society and the environment. Chapter 13. Investing in small cap and mid cap. Stocks. Small cap and mid cap stocks can offer higher growth potential than large cap stocks. Here are some things to consider when investing in small cap and mid cap stocks. 1. Higher risk. Small cap and mid cap stocks are generally riskier than large cap stocks. 2. Higher potential for growth. Small cap and mid cap stocks have a higher potential for growth than large cap stocks. 3. Less liquidity. Small cap and mid cap stocks may have less liquidity than large cap stocks. 4. More volatility. Small cap and mid cap stocks may be more volatile than large cap stocks. Chapter 14. Investing in emerging markets. Emerging markets can offer higher growth potential than developed markets. Here are some things to consider when investing in emerging markets. 1. Higher risk. Emerging markets are generally riskier than developed markets. 2. Higher potential for growth. Emerging markets have a higher potential for growth than developed markets. 3. Less liquidity. Emerging markets may have less liquidity than developed markets. 4. More volatility. Emerging markets may be more volatile than developed markets. Chapter 15. Investing in commodities. Commodities can offer a hedge against inflation and market volatility. Here are some things to consider when investing in commodities. 1. Types of commodities. Invest in commodities such as gold, oil, and agricultural products. 2. Commodity ETFs. Invest in exchange-traded funds, ETFs, that track commodity prices. 3. Commodity futures. Invest in commodity futures contracts. 4. Commodity mutual funds. Invest in mutual funds that focus on commodities. Chapter 16. Investing in real estate investment trusts, REITs. REITs allow individuals to invest in real estate without directly owning physical properties. Here are some things to consider when investing in REITs. 1. Types of REITs. Invest in equity, REITs, mortgage REITs, or hybrid REITs. 2. REIT ETFs. Invest in ETFs that track REIT indices. 3. REIT mutual funds. Invest in mutual funds that focus on REITs. 4. Individual REITs. Invest in individual REIT companies. Chapter 17. Investing in peer-to-peer lending. Peer-to-peer lending allows individuals to lend money to others, earning interest on their investment. Here are some things to consider when investing in peer-to-peer lending. 1. Types of peer-to-peer lending. Invest in platforms that offer personal loans, business loans, or real estate loans. 2. Risk assessment. Assess the creditworthiness of borrowers before investing. 3. Diversification. Diversify your investment across multiple loans to minimize risk. 4. Returns. Earn interest on your investment, but be aware that returns may vary. Chapter 18. Investing in crowdfunding. Crowdfunding allows individuals to invest in projects or businesses, often in exchange for rewards or equity. Here are some things to consider when investing in crowdfunding. 1. Types of crowdfunding. Invest in platforms that offer rewards-based crowdfunding, equity crowdfunding, or debt crowdfunding. 2. Risk assessment. Assess the feasibility and potential return on investment before investing. 3. Diversification. Diversify your investment across multiple projects to minimize risk. 4. Returns. Earn rewards or equity in exchange for your investment, but be aware that returns may vary. Chapter 19. Investing in robo-advisors. Robo-advisors offer automated investment management services, often at a lower cost than traditional financial advisors. Here are some things to consider when investing in robo-advisors. 1. Types of robo-advisors. Invest in platforms that offer automated investment management services. 2. Fees. Understand the fees associated with using a robo-advisor. 3. Investment options. Assess the investment options offered by the robo-advisor. 4. Performance. Evaluate the performance of the robo-advisor. Chapter 20. Investing for retirement. Investing for retirement requires a long-term perspective and a well-diversified portfolio. Here are some things to consider when investing for retirement. 1. Types of retirement accounts. Invest in 401k IRA or Roth IRA accounts. 2. Asset allocation. Allocate your investments across different asset classes, such as stocks, bonds, and real estate. 3. Diversification. Diversify your investments within each asset class. 4. Consistency. Consistently contribute to your retirement accounts and avoid withdrawing from them.